Hey everyone, this is John Rhoda. I am the portfolio manager of the Arteas Fund and owner of the Rhoda Financial Group, a registered investment advisor here in Virginia. And welcome to this week's video podcast of Markets in 4. Now, usually I try to alternate between a written format and a video format, but this week I'm going to be doing another video podcast since there's been so much going on in the market right now. It just doesn't translate well onto paper. So let's start out this week by taking a quick look at what's been going on in the U.S. equity markets. Now, stocks, they're still stuck in the same trading range that started way back in the beginning of August. And many traders are betting the market is going to continue to stay in this pattern, meaning that basically they're expecting the market to decline from the current level until either they see good news come out from the U.S. economy or that Europe solves its banking crisis. In fact, investor sentiment has also become pretty negative of late, and investors are becoming more and more bearish on the market. Now, this chart shows the ratio of bullish investors versus bearish investors when compared to the U.S. stock market. And the green line shows periods of negative or bearish investor sentiment. Now, what's interesting is this bull-bear ratio, which has been compiled by Investors Intelligence, has remained under 1 for a 6th consecutive week, giving us a reading of 0.87 this week. Now, last year, it also dropped below 1 just when the market bottomed in early July before last year's great year-end rally. Now, in the past, whenever this index has fallen below 1, historically it's been a great time to go shopping for stocks. And once again, it seems like investors are starting to take advantage of that. Now, one of the great organizations I belong to is the National Association of Active Investment Managers, otherwise known in the industry as NAME. Now, each week, NAME publishes an index of what current members are thinking about the market. Now, last quarter, the average of this index was 66.99%. 2 weeks ago, it fell all the way down to give us a negative reading of negative 3.56%. Now, this is a level that wasn't seen since the start of the 2008 bear market. Now, last week, the reading rose a little up to 0%, and this week, the level continued to rise up to 21.32%. So what do all these numbers mean? Well, basically, it's a good indication that money managers are starting to look for value in this market. Now, in addition, there was some further good news this week as inflation looks like it's starting to slow down a bit. Now, while inflation hasn't recently been a major problem, this past year it has been steadily rising, leading me to wonder if the word stagflation would soon be a term on the tip of everybody's tongue, meaning higher prices with no growth in the economy. Now, the recent data is suggesting that consumers may be paying less for food and energy in the near future, and hopefully this will translate into a strong holiday shopping season as consumers may have a little extra to spend this year. Now, also, money continues to exit from the bond market. This is also another good sign that investors are starting to reallocate their portfolio back into equities and away from bonds. Now, there's still some lurking risk out there, such as a potential for a major European banking crisis, but investors are starting to look for value in the market once again and are slowly moving out of less risky asset classes such as U.S. bonds. Now, lastly, we're also about to enter a historically strong period for stocks. This is a period where many investors become much more aggressive in the market in anticipation of a year-end rally. Now, I'm going to talk more about this historically strong period and what sectors outperform in my next update. So that's going to be it for this week. Please remember to check out my blog, Musings of a Money Manager, at johnrhoda.com for daily market updates. And thanks for watching this podcast, and I will see you guys next time.